Hello, and welcome to the fundamentals of pricing and our next segment, the recipe. We're going to get cooking here in a minute, so hang on, but hopefully you had a good time with our first session, the basics, and we're going to take you through a deeper dive into pricing. CapitalW Collective, again, is a nonprofit, and we are very, very focused on capital markets, education, elevating women and anyone and everyone in this space or around this space, and empowering through networking, development, growth, and so forth. So welcome back, and let's get cooking.
All right. Well, we decided to name this segment the recipe because there are lots of components of mortgage pricing. We walked through in our last session, fundamental session, really on the basics. So understanding the capital markets, understanding why the capital markets are important in the development of pricing, understanding the components of pricing. So again, following that same kind of format in that we're going to try to have a little fun here, but give you a video as well as corresponding materials that you can go back and watch us, if you're that crazy, a million times, if it helps with the understanding. This stuff is not the easiest to understand, and we've got a few years under our belts here, so we're trying to remember what it was like learning all these different components, doing the math where necessary, understanding the particular components. Our suggested audience for these sessions, the fundamentals, really is just about anybody in mortgage, but for loan officers or QC folks, folks earlier in their career, folks considering a career in capital markets, really for anyone. But especially in this pricing session that we're going to go through today, a lot of things probably that people don't understand go into, how you cook up an interest rate. So feel free to take your time with this video, ask us questions. You can submit those to info@capitalwcollective.org. Follow us on LinkedIn. Feel free to reach out to us that way. We are on LinkedIn under Capital W altogether and in space collective. And we're happy to engage with you anytime and anywhere. So let's go back to a quick refresher, Deb. We're talking about the secondary market and who the participants are.
You've got the lender, the borrower, and when the loan closes, the servicer. So that's your primary market. And then the secondary market is the group of various investors who may invest in the components of the interest rate. And again, the purpose of the secondary market, if a lender chooses not to hold the loan on balance sheet in portfolio, is to replenish cash to the lender to lend more money to more borrowers. And so the investors are looking for those cash flows and pay a price for it. So we talked about whether you can sell these loans as a whole loan or in a security through the GSEs, Fannie, Freddie, or perhaps Ginnie Mae, or in the private market. And we talked about the servicing value being typically a quarter for base servicing. And then if there's any extra servicing left over, or interest rate, I should say, we call that excess servicing. So just more cash flow. And some of that can be monetized and sold. We talked about that too. So remember, these components can be valued and sold into the secondary market as various strips of assets. And you'll hear us talk about the dollar price, which is where the secondary market refers to the amount that they're going to pay of that principal that you lent out, and that interest rate that goes along with it that they'll receive. The points that we charge the borrower, the interest rate and the points, is the other thing we talked about that put a value on that loan. And then we talked about the basis points, a way of expressing changes in interest rates or just interest rates in a different format. A lot of times you hear basis points more inside the company, capital markets. You don't really talk about basis points with the consumer. You talk about points.
Right.
So the main concept to take away here, because it's going to be evident in our recipe, is the relationship between price and yield, and that it's inverse. They're the opposite of each other. It's the relationship of the inversion between the price and yield is that when the price of the bond rises, the yield will fall. And when the price of the bond falls, the yield will rise. So keep that in mind as we go through the next session.
That's right. Yep. Very important. We'll get back to that. And so as we're talking about what goes into this recipe, what are the mortgage rate components, we've got to talk about what the ultimate disposition of the to-be created asset, the loan, will be. Are you keeping it? Are you selling it? If you're selling it, what are all the other components involved in the sale? So what's key drivers of this decision making? Well, first of all, it's the product type. So is it conforming, non-conforming, non-QM, QM, fixed rate, ARM? Those product types trade in different markets. Well, I should say it's the same market, but with different flavors and investors. And speaking of investors, those options can be limited for some products and greater for others. But who are these investors and what do they require in a transaction? What kind of price do they require? What kind of terms do they require? So if you're selling to the agency, such as the GSEs, the Federal Home Loan Banks, those what they will buy will differ perhaps from private investors. So back to the product type. If it's a non-conforming loan amount, GSEs are prohibited from their charter from buying it. So looking at the different investor options that might be might be actually portfolio buyers. So a bank that is originating a loan might buy it for itself, so having an internal transfer, if you will. But nonetheless, they are an investor. What are the loan sale execution types for those loans that are being sold, so not being held in portfolio? You can engage in a whole loan type of transaction with many different investors, including the GSEs. Others are security related, including the GSEs, but also some private investors are looking to create an RMBS, so that residential mortgage-backed security. It's private label, but it is a security in similar structure to GSEs. And then finally, the sale of the loan might also be accompanied by the sale of the servicing, or maybe not. So is the servicing being retained, or is it being released? If it's being released, how is it being released? There are different ways to release servicing in a flow basis, so on a continuous basis, loan by loan, or gathering a whole bunch of loans up and selling the servicing in a bulk manner. Lots of different expectations here in markets at different times by different investors. And the fun of a capital markets baker is understanding how those ingredients might be different out there. But it is that which creates the borrower rate ultimately.
Yeah, one day you might be baking a chocolate cake, and the next day a strawberry buttercream cake.
That's right. That's right. Well, speaking of cake, Deb, how about you walk some?
So let me take my cake idea through. Right. So it's really the basic recipe for conforming mortgage interest rates that we're going to focus on here. So there's, I'm looking at a 6-layer cake. You've got at the bottom the security coupon, then the guarantee fee, the servicing fee, excess servicing fee on top of that, pricing margin, and any risk adjusters that make up the entire really interest rate and points that go together to quote to the borrower. That's what you're really doing, is looking in the secondary market, seeing where you're going to probably sell it, how you're going to sell it, who you're going to sell it to, what are the components, and then you bake your cake, and there's your rate. But the most important concept to take away in thinking about this mortgage interest rate as a layered cake is some components are rate-based, other components are price-based. And then risk adjusters and pricing margin may be expressed in price. And I say maybe. So we'll see that in an upcoming example. But a price cost will decrease the dollar price and increase the rate to the borrower. A price benefit will increase the dollar price and decrease the rate. So this inverse relationship is an important concept to keep in mind.
And we will keep talking about that,
right?
Because it does get tricky as we start to do the math. Speaking of which, let's put our recipe card here out to walk through. And again, these are hypothetical, so we're kind of sticking with a conforming conventional loan that we're going to walk through with some made up values, but different products have different components. This is where we're going to describe to you the securitization of a conforming fixed rate loan in very hypothetical terms in this recipe. Again, private label would have different components. Ginnie Mae security would have different components, but we're going to walk through a conforming conventional. So,
or similar components with different values.
That's true. That's
right?
true.
So just, but this is really the mainstream.
Yeah, mainstream and fairly complex.
Yes.
As we're including some components here. So go ahead, take a deep breath. It's a little bit of math. It's not terrible, but we'll walk you through it. We're here to help you, and you can ask us any questions. So let's take the price pieces, which might be easiest to digest in your cake. First, the pricing margin. So we understand that this is a requirement, a profitability requirement, and in this example, this lender is pegging 2 points, so 2 points in price as the target of profit. The loan that we're hypothetically describing here has a risk adjuster of 0.5 point. So 2.5 points, pricing margin, risk adjuster together expressed in price is, in this example, going to be 2 components of the interest rate creation. Next up is for conforming loan guarantee fee. So in this example, we're suggesting that there's a 0.5 percentage point, so 50 basis points, as we're using that terminology interchangeably, in rate of a guarantee fee, which is the credit cost that the GSEs charge in this example. And what's unique about this particular example, we're going to walk you through the most complex one right now, is the concept of maximum buy up and buy down. So we talked about in the other sessions about excess servicing, above and beyond base servicing. Well, if you're a lender who would like to monetize, mean convert to price and be paid for that that guarantee fee, or pay upfront to have a lower guarantee fee, then you can exercise that option with through a buy up or buy down with the GSEs. Again, a little bit unique, a little bit probably nebulous here for first timers, but the understanding that that whole interest rate and the excess servicing that we talked about last session, you can do something with that excess servicing, and it's really the net present value of that future cash flow, and it can be converted into a price. Remember that relationship between price and yield? This is what we're talking about. In this example, we're saying there's a maximum amount of excess servicing that can be sold, and we're saying that's 25 basis points or 1/4 in rate. And there's a maximum buy down that can be done, which is buying down to 0. Hang on, and we'll walk through that in just a minute. But both of that buy up and buy down, the way we describe is through a factor called a multiple. And so those grids are per rate for both buy up and buy down. And that's how we will convert that excess servicing yield into a price. Servicing fee, we're going to go with the generic quarter in servicing fee, quarter in rate, so 25 basis points as we keep using that language. And then excess servicing fee in this example that we're going to use that multiple ultimately is 25 basis points to use as a bogey here. Not all loans have excess servicing. Right. So in this case, we created one that gave us an example so we could demonstrate that. And the both base and excess servicing multiples, so those 2 base servicing and then excess servicing fees, they each have their own grids and relative values, base versus excess. And so we'll be walking through with those factors on the conversion. But this is kind of the general setup for an interest rate calculation, and different companies have different ways that they measure or include components, but your one lender's terms with an investor might be different than another lenders, and so you could have some variability here. But these are kind of the main recipe.
Yeah, components. and I'll say this: when you look at this page and listen to Amy's description of each of them, and then we're going to walk through this. Really what's happening here is that 7% interest rate that we're ultimately going to get to is, again, broken up into pieces, like you said, the pricing margin that we want to keep as a lender, the risk adjuster, then we have to pay the guarantee fee to the Fannie Mae or Freddie Mac to ensure the timely payment, so that's the guarantee fee, and then basically, and then you have the servicing fee, the base servicing fee. So it's kind of like those are the primary starting components of the recipe, and then if you have some leftover, right, and your investor is going to want a certain percentage, right, but if there's extra, right, that we can either buy up that and give more to the agencies in terms of the guarantee fee or less, we can buy it down, or instead of giving it to them, we can keep that excess and value it for ourselves.
Right.
So, that's the way to think about that. These are just tools we could consider to optimize the price or our cash flow or both.
Yep. That's right. And so on each and every interest rate analysis that your capital markets or secondary marketing department conducts, considering all the options, and then a term you guys may have heard is best execution. So engaging in and creating a rate sheet from the expected best execution of all the options. So, again, decisions are made day in and day out and within the same day on how to price, and it's a function of the options that are available.
And the values that on those multiples that you talked about for the buy up or buy down that you could pass along to the agencies or keep the excess for yourself, they may differ.
Yep.
And that's part of that best execution.
Yeah. Well, speaking of multiples, how about we go ahead and go into the excess servicing and buy up and buy down multiples?
So, in talking about multiples related to excess servicing and buy-ups and buy-downs, let's start with base and excess servicing. It's a factor used to value the present worth of the base and or excess servicing income. A lender may choose to retain and value this base and or the excess servicing income, and a lender's valuation of the base and excess servicing is used in price analysis. So that multiple helps to arrive at the price analysis valuation. In the buy-up space, a factor is used, again, the factor being the multiple, is used to determine how much more a lender pays in guarantee fees for an additional basis point of servicing fee. Lenders agree to remit a higher guarantee fee than the applicable contract fee in exchange for a one-time upfront payment from the GSE. Lenders use this option to reduce servicing fee income, but there are limits on maximum buy-ups. In the buy-down space, a factor, again a multiple, is used to determine how much less a lender pays in guarantee fees for an additional basis point of servicing fee. Lenders agree to remit a lower guarantee fee than the applicable contract fee in exchange for a one-time upfront payment to the GSE. Lenders use this option to increase servicing income. Guarantee fees may be brought down to zero. So again, these multiples help you value whether you have excess servicing and want to retain that excess, or you want to instead buy it up and get a payment for sending the GSEs more guarantee fee than they asked for in the contract, or if you want to buy it down, and since you're delivering a lower guarantee fee, you need to pay the GSE for that shortfall, but you're optimizing your servicing fee income. Now, factors influencing multiples. Prepayment risks reduce the multiple because the future cash flows are less certain. Interest rate environment. Lower interest rates may decrease multiples due to increased prepayment activity. And loan quality can have an impact sometimes. The higher the loan quality with lower default risk typically drive higher multiples. Most importantly is the broad economic and market conditions that can affect the valuation of excess servicing. So when I think about that, it reminds me of what we talked about in the last episode around the pandemic related to how those broad economic and market conditions affect the valuation of the excess servicing.
Yeah, pandemic, and we've had different economic, localized economic conditions in geographic places. So we, back in the Great Recession, we saw different areas of the country, such as Florida or Las Vegas, where
Sand states,
where those values were much different than other parts of the country, and we can see those ebb and flow.
Right.
And I think also as we look more contemporarily on climate change and the impact of fires, of hurricanes, of tornadoes, of unexpected weather events where insurers are now changing their expectations, that can bleed into also the value of servicing as well. Well, I'll start over here on one of those main components of pricing, which is the Uniform Mortgage-Backed Security, so UMBS. That is a fungible asset. That what that means is both Fannie Mae and Freddie Mac can put a credit wrapper around the loans comprising pools within that UMBS. Prior to 2019, we had Freddie Mac securities, we had Fannie Mae securities that were not in the same vehicle. The single security brought together in 2019 the ability to have both insurers, as credit insurers, be deliverable into a single type of security. So it simplified, if you will, the vehicle within which the Fannie Mae or Freddie Mac individually securitized pools could take off and ride. So this standardized mortgage-backed security opportunity really created greater liquidity, and because they were fungible by both Fannie Mae and Freddie Mac, allowed for a little bit more diversification from investors. But those quotes are quoted in dollar prices. So we talked about that before as a percentage of par, but they have their own special type of language. As we look at this TradeWeb screen, you'll see some interesting numbers here and some pluses and other components. We're going to focus on right now. In a later session, we'll dive into more on individual bond pricing, but right now we're going to focus in on what does this mean. So, for example, if you have a price, because we're quoting in 30 seconds, and 30 seconds is a holdover from long ago trading. We continue that convention, and you might hear people talk about ticks or pluses. Even so, it's all relevant to related to the 30 seconds type of expression. But a price of 101-16 means 101 and 16 30 seconds, which if you convert that fraction, it's 101 and a half. So you might hear folks say 101 spot 5 or spot 2 or spot whatever. We're still talking about dollar pricing, and it's also though converting fractions to decimals. So don't be too confused, but understand that this is the convention with which traders have spoken of mortgage-backed securities for quite some time. The duty of the capital markets and secondary marketing group is to translate those into our dollar prices that can then be ultimately expressed on a rate sheet. But let's talk a little bit about the UMBS and how they trade. They trade in what's called the to be announced market, the TBA market. So you might hear people talk about the TBA price, and that is the lack of requirement to say exactly what loans are going to be in a pool is the to be announced, meaning I will announce later what this pool comprises. But right now it is a forward type of contract, a promise to perform, to deliver a security. And these securities settle on predetermined monthly dates. SIFMA, so the Securities Industry and Financial Markets Association, creates a calendar. And that calendar, because it is when all bonds settle, really drives the price to borrowers, because it is the time value of money. So a dollar today is worth more than a dollar 60 days out or a year out. That same time value of money is an influencer on what a lock period looks like for a borrower, driven from the SIFMA settlement calendar. Time value of money drives the lock periods, quotes, because it's the expectation of when a closed loan will be available to be put in one of those pools and then delivered in to the UMBS market, to the buyer of the security.
Very well said. Yeah, you go back to your interest rate to the customer. What do you want to lock for? I've already got my property, my sales contract, and the borrower and the seller, or the buyer and the seller will ready to close. Can your operations center get it closed in 30 days? That interest rate and points is going to be cheaper than if you needed 60 days.
That's right.
That's the most, when I take all this that we're saying, but what you just explained was where's the source of the price and when are we going to deliver that loan? Right.
Yeah.
We don't know what loans and when. Well, we do know when. If we're going to do a 60-day or 90-day, it'll translate back to your interest rate and points.
Yep, that's right. Well, all right. So now that we've talked about the bond piece, we've walked through all the different components that we outlined in the recipe. Now it's time to put all those ingredients together, start mixing them up, and bake it. So here comes the math.
Yeah.
All right, everybody, let's go ahead and start mixing and baking all of our pricing components here that we've been discussing. So to orient you on the slide, we've broken it into two sections, rate components and pricing components. Many of these rate components will be converted to pricing, so just keep your eye on that. We've also then included several different interest rates, so 7, 7.125%, 7.25%, with assumed execution options with the GSEs. So this is conforming conventional buy-up, buy down, or max buy up of loans being securitized into UMBS. We'll have our UMBS coupon that goes along with each one of these different types of executions. So we'll talk about the components there. And as well, then you'll have the applicable UMBS price that we've pulled off of the previous TradeWeb page. Included here are multiples in this column. We pulled those off of the previous page and added some. And then lastly, we will add all of these components together and get the final price. So let's just go ahead and start back up here at the note rate. So 7, 7.125%, 7.25%, and the execution type that corresponds with each one of these particular note rates. We've chosen to include a buy up, a buy down, and a max buy up. So let's talk about the buy up and buy down and why are we doing that? So in the buy up execution, it is the execution option where a lender can sell excess servicing rights to the GSEs in exchange for an upfront payment. And it's used if a lender wants to receive more cash upfront, they can increase the note rate of mortgage and sell the right to collect the servicing income. And the effect is that the lender gets an immediate cash infusion when we do that conversion here on the buy up. But in return, they accept a lower ongoing servicing fee because we've bought up that servicing fee. Now, the buy down execution here that we're doing for the 7.125%, what is it? Well, a buy down is the very opposite of the buy up. The lender pays upfront to retain higher servicing income over time. And it's used if a lender wants to keep a larger portion of the servicing fees over the time of the mortgage, and they are willing to accept a lower note rate and pay the GSE upfront for this benefit. So in effect, the lender sacrifices some of the initial cash, but earns higher servicing revenue over time. And depending on how a servicer values servicing, this may be a better execution ultimately to buy it down. And as the markets change, as these coupon spreads between coupons change, then there's also a different value to that buy down execution versus a buy up. And then this max buy up is when you hit the maximum amount of servicing fee that the GSEs will allow to be sold to them. Then the residual must be retained by the seller. And we've got a value calculation down here with some assumptions that we'll go through. All right, so let's just jump on into 7%. We've mentioned already that it's a buy-up execution, so we're going to be selling the excess as a guarantee fee buy-up. Consistent between all of these executions, however, will be the base servicing fee that the lender will be retaining of a quarter, as well as a guarantee fee of half in yield. That must be paid to the GSE to ensure, basically put a credit wrapper on this UMBS that we're going to be putting these loans into. So, consistently then, between all of these executions, there will be 3/4 worth of yield that we must take out first from the note rate. So in this case, 7%. We're going to subtract 1/4 so 3/4, leaves us with a net rate of 6.25. We've already said that we're going to buy this loan up, and so we're going to put it into a 6 coupon. That leaves us with 1/4 of yield, and we're going to utilize that G fee buy-up at the ratio provided by the GSE. More to come on that in just one second, but let's ground ourselves first on the equivalent UMBS price for our 6 coupon. Seeing that from the previous TradeWeb web page, the price here for the 6 coupon is par and 9/32. So par 0.28125. When we convert 9/32 into decimal, it's 0.28125. Add that to the par 0.28125. The value of the base servicing fee is going to be consistent across all of these executions because we are retaining a quarter servicing fee as in this servicing retained execution that we're showing here. The multiple that the lender in this example has chosen for that servicing fee value is 4.5. So the product of the quarter servicing fee multiplied by 4.5 equals 1.125, and you'll see we'll be using that same value across here for each execution. What will be different now is the execution type of the guarantee fee, buy up or buy down, or any additional servicing that's retained. So in this case, the green is showing us what components based on this execution type are to be considered. We are going to take that quarter servicing, excess servicing that we had, we're going to now buy it up. So a guarantee fee buy-up, we're going to be selling that. And so the quarter servicing, that quarter worth of yield, we're going to be converting it with the GSE provided buy-up value of 2.8. So that's how the GSEs are valuing that yield that they're going to be purchasing. So the quarter multiplied by 2.8 equals 0.70. And so the sum then, 102.10625, is the value now for 7% after we've taken into consideration the costs, the yield components, and converted them based on this execution type. So the sum of these green areas equals 102.10625. These other components where we have NA are inapplicable simply because of the type of execution. Let's go on to the second execution, 7 1/8. We're choosing the execution type as a buy down. So same components, quarter for the base servicing, half for the guarantee fee. That 3/4 we'll take out of the 7 1/8 note rate and have a net rate of 6.375. In this case, however, we are going to put this note rate into a higher coupon, and that creates now a negative value here, or an shortfall interest. So taking 6 3/8, putting it into 6.5, there's a negative 0.125. We are grabbing real quick the UMBS price from the TradeWeb screen of 102, and this is plus half of a 32nd. So plus equals a half. So 0.5 divided by 32 will get you that 0.0156. Adding that to 102, 102.0156 is the UMBS price. We're going to add to that price when we do our math ultimately here, the same base servicing value at the same multiple, 1.125. And now we skip down to the applicable execution calculation that we need to do with a multiple. Remember that excess or that shortfall of interest, negative 0.125 that we got from the subtraction of the 6.5 coupon from a 6 3/8 note rate. We're going to multiply that by the GSE given buy down ratio of 4.6 in this example, and that creates a negative 0.575. So we will be subtracting this amount of yield conversion, so now a price, from the value of the UMBS plus the base servicing fee. So adding 102.10 0.0156 to 1.125, and then subtracting subtracting 0.575 ultimately leads to 102.5656 as the price for this 7 1/8 note rate executed as a buy down. All right, then lastly, 7 1/4. This is our max buy up execution type scenario. So similar to this buy up over here, we're going to end up capping out how much we can sell to the GSE to monetize that yield, and we will have to retain the excess. So same base servicing fee of quarter, same half point worth of guarantee fee that we have to pay, and so subtracting that 3/4 from the 7 1/4 leaves us with a net rate of 6.5. Again, we will be putting this into a 6 coupon, and as a consequence, we will have a difference of a half of excess servicing. So, same UMBS price for that 6 coupon. That'll be our starting point when we do our addition. Same 1 1/8 worth of value from that base servicing when we convert it with the servicing multiplier, the base servicing multiplier. And then coming down now to our scenario here, it's a max buy up. So we are limited to a quarter only that we can buy up. And so we have to take the first quarter here out of the half, and we'll multiply it by the agency given 2.6 multiple. So that's 0.65 for this note rate. And then separately, we will now value the remaining servicing, that's retained servicing or excess servicing. And that is the half less the quarter worth of max guarantee fee that we could buy up, leaves us with a quarter. So we'll multiply a quarter by 2.4. That's the internal lender's value of excess servicing, and that equals 0.60. So the sum of our UMBS coupon, our 1.125 base servicing fee value, our max buy up, so that quarter that we were limited to at the agency provided multiple of 2.6, that's 0.65. And then finally, the excess servicing that we have to retain, that we cannot sell, at our internal multiple, 0.6. So that leads us to 102.65625 as our total price. And so it's important to note here that as the market changes, some of these execution types now become not the best execution, perhaps, or depending on what the goals of a company might be, whether they wish to retain servicing because they value it more than perhaps the agency does in terms of selling off the excess servicing, or it could be that there are opportunistic strategies that suggest how much should be kept or how much should not be kept based on a strategy of a company. So we have these various executions that we run all day, every single day in capital markets for all kinds of different rates for different products, for different scenarios. And a product and pricing engine is a fabulous tool to utilize to conduct all these calculations.
So it's we're mixing and matching some terms here, some language from dollar price and yield and multiples. Go back and take a look at the previous session, or rewind us here a little bit.
Yeah, it's not easy. Don't know how to get around it per se, and I'm sure others could do better than we did. But we're trying to at least chop it up for you. Yeah. Speaking of cooking,
yeah.
But I will say this, simplifying again, go back to 10,000 feet. Your borrower is going to pay either 7, 7 1/8, or 7 1/4 off the rate sheet, and we're trying to ultimately get to what are the points that are associated with that, and all the ingredients of the coupon that the investor is going to buy in our various scenarios there. And what do we do with the pieces? How do we value the pieces so that ultimately we get to a price, and then that'll turn into points?
Well, how about you finish this up here, because we're now talking about how do we convert those investor prices to rate sheet prices. We did the calculation of the sale to the investors, but we left out a couple of pieces before we actually quote an interest rate to a borrower.
Yes. So let's add the frosting to this and converting base pricing to borrower quotes, which is where I was headed, building us up for this. So if you look at the base pricing calculation of the 7 1/8 rate, we had the 102.5656 price. And we now need to add what pricing margin does a lender want to make. So we're going to have to take away 2 points for ourselves out of that investor paying us
That's right.
2 extra points above par.
In our hypothetical. Could be more, could be less, depending on different,
This is just our scenario here. It's a snapshot.
Yeah.
And then there's a risk adjuster on here, 50 basis points, 0.5% in price. So we're going to take 2.5 points, which ironically brings the final secondary marketing price on that 7 1/8% note rate to just about par, right? Par 0.0656. And so we usually round, make it easy, and the borrower quote will be 7 1/8 and 0. So that's our par rate quote. Hey, borrower, can you write a lock? Because here's your rate.
Right.
But look at that investor price that we did all the pieces and parts, got us to 102 and change, and then we had to take some more out for the risk and the profit margin, so that we could make money, and then the borrower pays 0.
And I have found it interesting that borrower language has kind of changed over the years.
Yeah.
So, the even eighths have, really was the typical thing, but with, so an even eighth on a note rate and an even eighth on a price quote. But now, I myself have a 90, 0.99 rate, which we can always calculate any yield. Yeah. So there's no prohibition. So just because it's a commonality in terms doesn't mean that it's impossible. So by, a 2.99 rate or a 7.99 rate or a, 7.199, I've seen all kinds of different things, different gimmicks, but you convert all of that yield using those multiples that we were discussing. So you can translate anything and everything into a yield or a price. It's just math, but conventions sometimes have us, have a speaking dollar price or 30 seconds or eighths. It's all just
depending on your audience and the context. And is it the investor? Is it the borrower?
That's right.
And we're trying to get these down into the smallest increments that can be valued, whether it's a basis point or a 30-second. They all are equivalent math expressions.
That's right. All right. Well, that was the tough stuff. So again, go back and rewind, study the math, remember your terms, what's the orientation, which language are we speaking, what are we trying to do, convert yield to price, and please, by all means, send us questions to info@CapitalWcollective.org, or you're welcome to send us something on LinkedIn, Capital W altogether, space collective. You can find us on LinkedIn. We're happy to answer any of your questions, and we look forward to presenting some additional components to our pricing fundamentals session very soon.
Thank you.
Thanks for watching.
Good job, Amy.
Thanks.